It's Friday, October 15th, expiration day. After just some violent equity moves here the last 2 days, what you're looking at here is the S&P 500. And we talked earlier this week about the fact that there were so many put positions that were set to expire on Friday, that's today, that if nothing happened or if something set up to kind of ignite a little bit of rally, all of those puts that were set to expire on Friday would get crushed. And that is what happened in spades. I mean, particularly in the NASDAQ, which outperformed pretty sharply into yesterday. That just fueled the market higher and really blew through levels that we didn't think were going to happen. I mean, we really saw resistance around the 44.20 area initially, and that's why I wanted to bring up this video because we found a few things that were quite curious in this rally, and we sort of see a little bit of an air pocket underneath. Now, what is so interesting is the rally had such a large magnitude higher, and the gamma change was so steep that I think it was enough to catch the market for next week and possibly set up, a pretty sharp rally. I mean, I'll admit to being pretty bearish with the setup last week when we were down around here. So interesting is the Fed minutes took place this day, and I generally think those Fed minutes are somewhat pointless, but that seemed to flip something of a risk-on switch. I mean, uh, asset classes of all types seem to just launch north on Thursday and Friday, from the AMCs of the world. Obviously, we have Bitcoin with the ETF moving just substantially higher. I mean, as you can see on the screen here, it's another 10% today after another big move. So all of the risk-on signals seem to just be flipping on here. And the VIX, which is in the sub-pain, I mean, the magnitude of this move lower, we had a 15 handle on the VIX today, which is just pretty unbelievable. Didn't see that coming for today, but we did see just this flush of put options out of the market. But I think what has happened is that along with that flush of puts, a spade of calls have come in. A lot of call positions have come in. And we're going to show you that here on our daily post. So that's where the market exists now. Such a vol smash that it lifted the market up over this key line, 4,400. We've been saying for a while. This is and was our bull bear line. Bullish above, bearish below. There's just no other way to state it. Regardless of what you think is going to happen in the market, above 4,400, positive gamma invokes, and that should support the market. And now that we've moved up so much, another 2% past that line, gamma is now quite positive, even considering this expiration. So this is our note from this morning, and we pointed out that even though vol got smashed, there was this big volume yesterday in put and calls at 4,400. 80,000 calls and 100,000 puts. That's intraday volume yesterday is really big, and another 60K at 44.50. So all of this call volume came in. These puts were net open interest on these put and call lines were only changed by about 10 or 15,000 contracts. So it didn't affect open interest much, but that intraday volume, I think, really propelled that punch to get the market up over into the 44.50 area, which is kind of like a safe zone, right? 44.50 put some padding in there. We're not on the cusp of gamma flipping negative, which takes place around 4,400, and so that punch higher really served to the bull's purpose. One of the things that we also thought framed this very well was this vanna model. Now, a lot of people have questions about the vanna model, and essentially what you see here is yesterday's snapshot. Now, this is the market down around 43.75, 43.80. Now, keep in mind that after we had run this model, the futures had already rallied fairly sharply. But what you can see is we call it a left skew to this model. Now, if you look at this blue line, the blue line estimates the delta exposure of options market makers portfolio, essentially of the entirety of the S&P 500. So if this blue line is higher, it means that the delta or the positive market exposure that the options portfolio holds for dealers gets larger. So at the money, which is around 43.80, 43.85, the dealers have 1.5 billion in total exposure, and then if you ratchet that or shift that higher, their exposure grows up towards 1.6. So what this is, in other words, is telling you is that their options portfolio makes them longer the market as the market goes up, and so they should start to sell futures to offset that loss or that extra cost. And you can see that as we pulled into 44.20 area, that delta increased sharply, which means they should be selling futures, and that should create a resistance point. Now that was the model that was based on the pre-open. As we showed you here, tons of calls and puts came into the market. In addition to this, as we noted here, there was 500,000 calls trading at the Spider 442 mark, and the Spider position is every bit as big as the SPX here. So uh, our point here is that even though our snapshot showed resistance would pick up around 44.20, that intraday volume gave that market the extra juice to kind of pull up a little bit closer to 44.50 yesterday. So you can see that yesterday, obviously, this 44.50 area was really resistance, right? So that's more or less in line with the Vanna model. Now, if you look at today's market Vanna model, you can see that now if the market pulled above 44.60, which is our big resistance strike, 44.70, 44.80, that resistance build, the notional exposure, positive delta exposure of the options portfolio for the S&P 500 increases, which means that more futures have to get sold. So as the market goes up, the pressure increases. And then as the market slides down, the dealers can start to buy back some of those short futures. That action, that positive gamma hedging, is what should collapse volatility now. And as volatility comes in, that should serve to help to base the market, provide us a base for the market to shift higher. I was not expecting this magnitude of a jump. Now, obviously, we're going to lose about 30+% of gamma to today's expiration, but the gamma jump was so high that I don't think it should have a big impact on the market into Monday. But the critical point here, and I'll mention this a few times. If the market cannot hold 4,400, then we reserve the right to flip back to being sellers again. But given the weight of evidence right now, you have to sort of give edge to the bulls. One last note on our support and resistance levels today, even though we're at the close. You can see here, this is called our profile strike. So what we do is look at the size of total spider gamma and SPX gamma and weight those, right, and back those prices out to be on SPX only terms. And you can see that when you look at combined spider and SPX gamma, there's huge bars up here at 4507 and at 4560 roughly, which means that once the market's in this zone, it's pretty well padded, right? There's a lot of positive gamma that should support the market. Now, if we had rejected 4460 this morning, there's not much support under here. And this is kind of what the concern is, right? If we lose some gamma, if futures kind of give some back, you could have a very slippery slope if we break that 4,400 line. Now, that is now 2% below basically where the market is trading. But that is what's making this a little bit of a tricky market to call. We do break down that gamma position change. If you flip over to this Vanna and gamma screen, you can see that as of today, the amount of gamma that's set to expire is essentially going to take us from this amount of positive gamma here, which is basically about $1 billion, down to about 500 million. If we are a little bit closer to 4,500. So, there's a fair amount of gamma that is expiring at positions above here, but really this is not because of the rally and the position change yesterday. It's not quite as much of a devastating change really as we were looking at, as we had anticipated going into this week. We couldn't have predicted that volume that really flowed in yesterday. It was, of quite a magnitude. Again, you can see, the cues, as we mentioned several times this week as well, were just poised for volatility, right? And that volatility chose to respond to the upside. Now, the other thing that's kind of having us change our tune a little bit from the bearish narrative is how hard the volatility was just sold. I mean, the VIX, as we mentioned today, did have a 15 handle to it, but we want to flip over to this other platform, convex value, which we've just started to play with a little bit, and look at the term structure here of the S&P. If you look at this, this is today's term structure, and you can see how much in contango this is. Near-term volatility, which is something that has not been sold these last week in the market, a few weeks. The market has not been able to rally, and it was sold hard yesterday and today. And here we are, we really ripped higher. And, it seemed to time with those Fed minutes. We don't cover macro here, but there's a coincidence there. Fed minutes came off overnight. We had a big rally on Thursday night, and that led to the very strong rally into noon Eastern time yesterday. So if you just look at the term structure going back just a few days here, which is a pretty neat little feature. This is the term structure on October 1st. I mean, you can see on the screen here how flat that term structure is, and this was when the S&P was down about 100 150 points from here. So all of this volatility, I mean, this is the FOMC day. You can see the vol is bleeding out a little bit, but the smash that took place over these last 2 days was just relentless. If you look at the implied vols for like Monday and Wednesday's expirations, they're back to realizing something like an 8. So clearly, um, the near-term risks, whatever the trigger was for markets to kind of give the risk on all clear, seems to have been invoked. I mean, if there was concerns for sell-off last week, we likely would. Excuse me. If there's concerns for sell-off next week, we probably wouldn't be looking at an 8 implied vol for Monday's expiration. So this implied vol smash, this magnitude of it uh, was really pretty surprising, and has led us to change our tune a little bit. When the data changes, you gotta go with the flow, and you gotta update your view of things. So that's very important. The last thing that we kind of want to note, which is so interesting, is I don't have this data on our screen here, but our hero indicator, which measures the real-time delta that's been traded on the day, both yesterday and today was distinctly negative. Now, with vol getting smashed, that suggests that it was primarily, or it is primarily, calls being sold. And we think that's the case today. I mean, the deltas are just very, very negative. And if you look at this price action, there's this gap higher in futures overnight. This was the same story yesterday. Gap higher. We run until about noon when the European markets close, and then we trade sideways. And that is essentially the same thing that happened today, right? We gap up at the open, and then we just trade sideways all day. But these are very heavy negative deltas that are getting sold. So the overnight action is positive. It jumps up, and we think that people are laying on now upside calls, which is part of the general program here. As we go up, traders tend to sell those S&P calls to monetize some of that. So that is some interesting action. If the deltas were negative because of put buying, we would obviously not be seeing the VIX down, the level or magnitude that it is. So there is some call selling overhead that does help to build positive gamma and hold the markets up. The largest, sorry about that. The largest call open interest is 4,500 right now in the S&P, and so that is the obvious magnet point here for the market. And look, as we said before, this is quite a state change in the positioning. And we think it was triggered by some type of a macro event that just gave the all clear sign to smash that option implied vol and go risk on. So with that, if you have any questions, please post them in the comments below. You can get a free trial of SpotGamma by going over to SpotGamma, hit subscribe now, and you get a free 5-day trial. You get access to all of our notes going back in time, so you can see exactly what we thought on every single day and how that played out. You can see why we saw this big volatile move coming, and what the setup was for that. We are also on Twitter at SpotGamma, and you can also reach us at info@spotgamma.com. Thanks.